Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings and see what is really going on underneath. Today we're diving into STRATA Skin Sciences Incorporated's latest quarterly report, a document that has got some interesting financial twists and turns that we need to unpack. Before we jump in, if you love getting raw, unfiltered insights straight from these corporate filings, make sure you are subscribed. And hey, we've got a fantastic community growing on Discord, all linked in the description below, so come join the conversation. So STRATA Skin Sciences Incorporated is a medical technology company that focuses on treatments for skin conditions. Think things like psoriasis and vitiligo using lasers and light systems, and they also have a system for acne. This report covers their financial performance for the 3 and 9 months ending the 30th of September 2025. It is a look at how they're doing financially in the most recent quarter and also the year-to-date performance. Let's start by looking at their assets and liabilities. As of the 30th of September 2025, their total assets were about $30.7 million. That is down from over $34.9 million at the end of 2024. Now, a good chunk of this decrease comes from their cash and cash equivalents, which went from over $7.2 million to about $7 million. Also, their accounts receivable, which is money owed to them by customers, dropped significantly from over $5.2 million to about $3.5 million. This could mean they collected some money owed or perhaps sold fewer products in the lead up to this quarter. On the flip side, their inventories went up from about $2.2 million to over $3 million. This might suggest they are stocking up on supplies, or perhaps products are not moving as quickly as anticipated. Their total liabilities also decreased slightly from nearly $30 million to just under $29.5 million, which is a positive sign showing they owe less to others. Now let's talk about their revenue and profits. For the 3 months ending the 30th of September 2025, their net revenue was about $6.9 million. This is a decrease from about $8.8 million in the same period last year. Looking at the 9-month period, their revenue was about $21.4 million, down from over $23.9 million in the prior year. This revenue decrease is quite significant. Their gross profit, which is revenue minus the cost of making their products, also went down. For the 3-month period, it dropped from over $5.2 million to about $4.2 million. In the 9-month period, it fell from over $13.4 million to about $12.2 million. This means the money left after covering the direct costs of their products is shrinking. What is interesting is that their gross profit percentage actually slightly improved for the 3-month period, going from 60.1% to 60.4%, and for the 9-month period, it went up from 56.1% to 57.3%. This suggests that while they're selling less, they're perhaps selling more of their higher margin recurring revenue products, like their treatment models compared to equipment sales, or maybe managing their costs better per unit when they do sell. This profitability picture leads to their net loss. For the 3 months ending the 30th of September 2025, the company reported a net loss of about $1.6 million. This is better than the $2.1 million loss in the same period last year. Looking at the 9-month period, the net loss was about $6.3 million compared to $5.5 million in the prior year. When we break this down into net loss, per hair for the 3-month period, it was a loss of 36 cents. Per hair down from 51 cents per S-hair the year before. For the 9-month period, the loss per S-hair was $1.48 compared to $1.50 a year ago. So they're losing less per hair in the 3-month period, but their total year-to-date loss has slightly increased. Now, it is always interesting to see how much companies spend on their employees through stock. For the 3 months ending the 30th of September 2025, they recorded about $212,000 in stock-based compensation. This is up from just $26,000 in the same period last year. For the 9-month period, it was about $469,000, up from $301,000. This increase suggests they are either granting more stock options or the value of existing grants is increasing, which could be a sign of efforts to retain or attract talent. Let's talk about cash flow. For the 9 months ending the 30th of September 2025, the company used about $2.6 million in cash from its operations. This is a big increase from the $515,000 used in the same period last year. This increase in cash used is primarily due to higher net losses and some changes in their balance sheet accounts. For example, they paid out a significant amount for sales and these taxes related to their extract treatment codes, which is a large outflow. On the investing side, they spent about $1.2 million on property and equipment in both periods, and this is pretty consistent. Then for financing activities, they had about $2.2 million come in from selling stock in the first 9 months of 2025 compared to $1.9 million last year. This shows they are relying on stock sales to fund their operations. Speaking of stock sales for the 3 months ended the 30th of September 2025, they sold over 1 million shares, raising gross proceeds of approximately $2.4 million. So they are actively selling shares to raise capital to keep the business running. Now let's look at some specific notes. In the note about commitments and contingencies, they mention contingent consideration. This is basically money that might have to be paid out in the future based on certain performance goals, usually related to acquisitions. For the TheraClear Devices acquisition, they had potential earnout and royalty payments. However, and this is important, they entered into a settlement in October of 2025 and have been released from these future payment obligations. This is a huge relief for the company as it removes a significant potential liability. They will be writing off related intangible assets tied to these payments. This is a really important one. The company is engaged in ongoing disputes with New York and California over sales and use taxes on their extract treatment codes. They lost a major appeal in New York and had to pay out $1.3 million from a bond they posted. This tax issue has caused significant back and forth, and it seems like it is still an area of concern with remaining assessments in both states. They believe they have grounds to appeal further by arguing their services are more like non-taxable medical treatments. This certainly adds a layer of uncertainty to their financial picture. Let's check out their debt situation. As of the 30th of September 2025, their long-term debt was about $13.4 million. This is down from over $15 million at the end of 2024. They have a senior term loan facility, and they are currently making interest-only payments and will start principal payments in July 2026. They also have a financial covenant requiring minimum net revenue, and as of the 30th of September 2025, they were in compliance. However, they recently entered into an amendment that pauses the measurement of net revenue for financial covenant compliance until September 2026, which is a pretty significant win and gives them some breathing room. Moving into management's discussion, they acknowledge the ongoing impact of COVID-19 and also mention the effects of the Russia-Ukraine war on noble gas supplies, which are essential for their lasers. They also note potential impacts from tariffs. They are actively increasing their direct-to-patient advertising for extract treatments to boost awareness and drive patient visits to their physician partners. So let's look at the bigger financial picture. They provide a reconciliation from their net loss to their non-GAAP adjusted EBITDA. For the 3 months ending the 30th of September 2025, their adjusted EBITDA was actually positive $10,000 compared to a negative $240,000 in the prior year period. For the 9-month period, it was a negative $1.075 million compared to a negative $497,000 in the prior year. This reconciliation shows that after adding back things like depreciation, amortization, and stock-based compensation, they are closer to profitability than their bottom line net loss suggests. The positive adjusted EBITDA for the 3-month period is a glimmer of hope. Now, looking at STRATA Skin Sciences Incorporated's latest report, it is clear they are navigating a challenging financial landscape. Their revenues are down and they are still reporting net losses, which is a concern. However, there are some positive signs. The improvement in their non-GAAP adjusted EBITDA, especially the positive figure for the quarter, is encouraging. The settlement of the contingent consideration significantly reduces future liabilities, and the recent amendment to their debt agreement pausing revenue covenant measurements provides much needed flexibility. The ongoing sales tax disputes are a significant risk and could lead to further financial pressure if not resolved favorably. Their strategy to increase direct-to-patient advertising aims to boost demand, but success will depend on market acceptance and insurance coverage. Overall, STRATA is in a transitional period fighting to find a sustainable path to profitability. They're actively managing debt and working to reduce liabilities while trying to grow revenue through targeted marketing efforts. Alright, that is our deep dive into STRATA Skin Sciences Incorporated's latest financial report. What do you think about their performance and their strategies moving forward? Let us know in the comments below. If you found this analysis valuable, make sure to hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching, and we'll see you on the next episode of Corporate Decoder.